Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I will be your host for about the next 30 minutes here on Options Guide TV. Today is Wednesday, February 14th. The markets are rocking and rolling. We've had a good bit of earnings. We're now on the tail end, I guess I would say. I don't really feel like earnings is complete until we get to NVIDIA, which NVIDIA for some reason just cannot stop going up. It's trading right now at 728. On Monday's portfolio, we even showed you our deep in the money call option that we bought way back in November. That call option is already up 80,000 in that position. It was a fairly small position too. We didn't want to sell any calls on it. Don't want to sell any calls on anything that is going to be announcing earnings. If we're looking at our deep in the money call portfolio as a substitute for the stock. So that was just a little foreshadowing of what we have in that portfolio, which is the paper trading portfolio. Today, I have the actual portfolio up, just the test account in the TradeHawk software. We're going to look at the trade that we trepidatiously talked about on Monday, which just didn't work out. It's really that simple. It was a short put spread, basically hoping that the market would stay flat. That's really what we were looking for. It didn't think it could break down below the 5,000 level, and it has. It's bounced back a little bit, but the position is still really hurting. So it's the market right now is at 49.66 in the SPX, and the SPY is 495.54. We were in the paper trading portfolio. We decided, well, let's just throw something out there for a couple of days, and we sold the 148s and bought the 144. We did it for around 40 cents on that trade. So just a real short trade that was going to be expiring today on that position. So if we looked at that trade, might have did we do the 16th? If we did the 16th, I feel like we did it. I didn't take a screenshot of it because we did it at the end of the day. Let's look at this one. Let's look at, we sold this, bought that, 160. So in that situation, the market is, oh no, that's what I'm doing wrong. SPY. Okay. That makes more sense. All right. So this would be today, 148 we sold. Apologize for that. A little bit of a miscue. We sold the 498s and bought the 494s. It's trading for 224 right now. If I had this position on, it's really not an adjustment. You might have adjusted it yesterday, but in the short put spread world, and this is just to go along with all of the butterflies that we did in the SPX. Remember, we were doing a weekly butterfly, and for 5 or 6 weeks straight, just waiting for it to get to the 5,000 mark, to that all-time high and that magic big round number of 5,000. And it did it one day after. We actually would have been a complete home run. It was a very good trade, very good series of trades. And as I say, and I always want to clarify this, that these are paper trades. They're not meant to be, we don't know exactly what you're doing in your portfolio. But the SPX is more of a staple trade that you would put on. Today, we're going to look at Coinbase, for example, because they're going to be announcing earnings. We're still in earnings season, and there's a lot going on with Bitcoin. Bitcoin just hit $1 trillion market cap once again. We had one of the other companies in the space. I guess they would be more of a crypto company than I think a stock brokerage firm, but Robinhood announced earnings, had really good numbers, and they've been beaten up. So a little bit of catching a falling knife, but that kind of started it. And Coinbase is, I think, jumping today off of that news a little bit as Robinhood, which is symbol HOOD, Hood, is climbing. And then we see Bitcoin over $1 trillion market cap once again. So we're going to look at Coinbase just to see what they're doing ahead of earnings. I don't like the fact that it's popping so much today, but we're going to do a speculative trade in Coinbase. And I want to emphasize this, in a portfolio, we would not do this many speculative trades around earnings, but you learn a lot about option pricing and option strategies around earnings. The SPY trade we kind of did on a whim, but that's a valid trade. That's something that I would look at, especially we talked on Monday about the hesitation to see if the SPX is really going to stay at 5,000 and go beyond. Is it going to create a support level on the downside? And it obviously didn't. The numbers, they're saying the downside came from the reaction to CPI. And a lot of those numbers that were announced on Tuesday morning. Now, the numbers weren't bad. Inflation is still going in the right direction. But I think what really happened with the numbers is it became very apparent that there is no longer going to be a rate cut at the next Fed meeting. They're thinking about all the way out in June. Now, some pundits are actually saying maybe no rate cuts whatsoever. At one point in time, they were talking about 6 rate cuts. Now they're down to about 2 rate cuts. And I personally don't think it will happen in June. The Fed fund futures say that there is a decent probability, around 50% chance at this point in time, that they're going to cut rates in June. But that number has been very volatile. And yesterday really hurt that number. It was up around 60%. It dropped down, I think, around 40%. And actually, let me take a peek at it. Let's see where we're at in June. Let's just stay right where we're at. And let me just take a peek on my own. All right. So the June expiration right now, they are saying it's a 53% chance. It's still at a decent range of a rate cut in June. That's like the most probable from looking at the CME Fed Watch tools. And if you go all the way back to a week ago and looking at this, yeah, it actually was around. So I think what has happened is the emphasis has switched from March. In March, they're now saying that there's a 35% chance. And in June, now they have a 53% chance, because it actually jumped a little bit after yesterday's announcement on CPI, which I find interesting that it went up a little bit from around the 40% level up to about the 53% level. And they're even pricing in a possibility of a 50 basis point rate cut, down around 25%. I just don't see it happening. Jobs are too strong. The consumer is too strong. And I think that is kind of what drove the markets down. But then again, it could be just the fact that the markets have been so strong since November. Since the beginning of November, SPX and most of the indexes have gone just straight up. The Russell is a little bit of a laggard, but it's getting ready to pop too. And that's part of the reason why we're going to look at it today. So if you have any questions on this trade that we looked at on Wednesday, there's not much to do. I would probably just close out of this. It's at 496. Max loss would have been $4. Paid, I think we received about 45 cents for that trade. Once again, it was really just kind of done to have something on so that we could watch it by Wednesday. Okay, so let's get into the heart of Options Guide TV today. And we're going to start by looking at a chart in the Russell 2000 index. So if you have any questions, please feel free to put them in the chat box. Happy to try to address them. But I'm going to come back to the well. On Options Guide TV, and this is a legit trade that I have done in the past and will do again in the future in my own account, is down here at this bottom, when we came down and we touched, this was, let me go way out, just because the Russell very rarely stays within a channel and reacts this way. So let's hope I don't freeze. We're going to go out many days. All right. So if you see the Russell, it's usually all over the place. It's a very uh, it's actually not a very good charting index. You have a lot of small cap companies, and by the way, we're looking at the IWM, which is the ETF, not the actual index. And this is what we're going to trade today, and we're going to look at this trade. We channeled a little bit here, broke up, looked like the market was ready to rock and roll. This is back in this looks like in December of 21. Then, of course, we had all the news that happened, came running all the way down. We started this well-established channel right here, and we did a long straddle right at 163, right at the bottom of this, because we came down 1, 2, this would have been the third time. So either we were going to break back down to this level or go way back up in the channel, and it did, and it went up strong. So we're talking from 165 to 200, and now we're in the exact same situation. 1, 2, 3 times. We looked at it, and I'm going to zoom in here. We looked at a trade right here where we were, I think we considered a long straddle at that time too, but we had the breakout, and it really look how many candles do we have above? 1, 2, 3, 4, 5. That's 5 days. 6 days still above. 7 days, and that was even an update because it's a white candle. And then we finally broke back down again. So that was definitely a head fake. And that's the Russell 2000 index can do that. Well, any stock can, but the Russell is known for that. We still got our ducks in a row. So the Russell is looking strong in that we got the 200-day below the 50-day, below the 20-day. We never did cross over that. The 50-day looked like it added a little bit of support. This is where the bulk of the volume was, right around that 50-day. And now guess what? We broke out again. So every time that it breaks out, it's harder. It's more and more positive that if it comes back and fails, and we didn't come all the way back down into this channel. So right now, the Russell 2000 index is looking interesting. We're up 260 on the index today, 197.21. So let's do it again. Let's look at a long straddle. Now, in this, if we stayed solid here, and we could even bump up to the top of this run up in the S&P 500, that's 205.42. So if we got somewhere around that range, I wouldn't even mind just getting long a long call spread or something. But I'm gonna stick with my guns. We're gonna look at buying the long straddle. It did not work here. It worked there, and it's worked many times. If you just even go back, if you were just buying at the lows of the channel and at the highs of the channel, wondering if it's going to break out, this was a good trade. You wouldn't have bought here. You would have had to wait till it never would have came down into the area, but you would have thought about it here, and now we're there. So here's our trade. We're going to go out. We're going to give us some time. The vol isn't ridiculous in the IWM, but it is higher than most ETFs would be. For example, obviously the SPY, or the one that tracks the ETF that tracks the S&P 500 index, trades usually around 13-14% implied, fairly close to where the VIX is at. We'll go out to the February 20th expiration. If we look at that, that's trading around a 21% implied. And IWM, just want to make sure I'm in the right marketplace, 22, 23. It's not outrageous. You know, you're looking at Apple's implied volatility. I think Apple trades right around that price too. Let's see, AAPL. I think they're right around, yeah. So they're at a 20% implied volatility. So IWM is very similar. The type of premium that you're paying for is very similar to paying that type of vol premium that you would in an Apple option contract. So we can go out. Let's look at, this is the 16th. Got 16 days. Yeah, let's go 16 days. Let's go into March. February can be a volatile month as far as the calendar is concerned, and I do pay attention to that. And that actually worked out really well for us last year on Options Guy TV, getting short in September and October and getting long in November when you saw the seasonality of the marketplace. So February can always be kind of a scary month. So let's go all the way out to March. Let's do the 16-day option contracts. we're gonna, and as always, well, let's jump out here for a little bit, and I'm going to transfer over. Let's look at the options playbook. Let's pull it up. Why not? So give me a second here to switch screens. Okay, and I'll show you what I was looking at then. Now that we're here, and I got the playbook, let me pull this up. 1 second. Let me get to the strategy. Long straddle. Okay. So let's start by looking at the CME FedWatch tool. Let's just take a picture. I'll show you what I'm seeing here. So this is the June expiration. 35 days till the next meeting. I love this site. I start every morning. Well, not every morning, but I like to look at this at least a couple of times a week to see what the FedWatch tool is doing, especially in these markets, right? And a lot of times this was just boring to watch because the Fed never did anything, but that is definitely not the case anymore. Here's the June expiration. So this is the most recent one, which is in March. This is the March expiration. They got the probability extremely low. Current market is 525 by 550. This saying a 90% chance that it's going to stay there. And there's a 10% chance that they cut in March. But it's not zero. So they still are giving it a chance. I mean, if you ever think about, I like to think of it as the weather. How many times have you seen them say there's a 10% chance it's going to rain and it rains all day long? So that saying that there's not, the probability is not zero. Okay. So now we go to May. May, they got a 38% chance. And I was kind of surprised to see that prior to, so here's the 38%. A day ago, it was at 32. They're now saying there's a higher chance after the big number. And 1 week ago, though, it was at 53%. So it has came off quite a bit, I guess, with the economic number. A month ago, it was at 17%. But I think most people are really thinking June. Even though the futures and the prices of the futures are kind of predicting that, most of the people that are looking at what's going on with the Fed and just what they are saying, I think this is the wishful thinking from the marketplace that May has a higher probability of a cut, a 25 basis point cut in the Fed funds. Now we're out to June, and in June, they are saying there's only a 20% chance. This is the current rate. There's only a 20% chance that they stay at the current rate. Now, these numbers are all going to add to 100, right? So there's a 51% chance of them cutting 25 basis points, and they're giving it a 26% chance that they cut 50 basis points. I don't know where that number comes from whatsoever. I do not foresee that. But then again, the market usually knows best. But in this point in time, maybe June, they're looking at a rate cut. So you can combine these two. If you take 51 and 26, you're looking at a 77% chance of a cut, according to the CME FedWatch tool and where the Fed future or the futures contracts are trading at right now. Okay, so before I get too long-winded here, let's look at a long straddle. So I don't talk a lot about long straddles. Here's one of my biggest things. Obviously, this is my website, optionsplaybook.com. So obviously, check it out. And if I look at a long straddle, you have a long straddle and you have a long strangle. Let's open this in a new tab. If I'm speculating on a trade, I very rarely would do a long strangle. If I'm doing a shorter term trade. And here's the reason why is you're buying two out of the money options. And I'm not a big fan of buying out of the money options. I think there's a time and a place for every strategy in the playbook. And that's part of what Options Guide TV is all about. But the probability of it, if anything, I want to flip this upside down and I would do a short strangle, because you got this little area between strike A and strike B where you feel comfortable, right? If the stock is always within that range. Now, on the long side of things, I'm not comfortable. That's where the max loss is. If we look at a long straddle, it's very hard to get the max loss. In other words, you pay up for it, but the odds of it stopping right on that strike price, right at expiration, and you didn't get out, which means you definitely would have got the stupid award for that. But if that does happen, and you lose the maximum on the long straddle, that would just be dumb luck, extremely bad luck. So if I'm doing a shorter term straddle, I usually will do the straddle instead of the strangle. I like the odds better. You got to pay more, which means you have more risk, but the odds of losing everything are extremely low because it would have to stop right at that strike price. And I also like the reaction of the way a long straddle works. If you think about this, I'm buying strike A, a call, and I'm buying strike B or strike A, a put, the same strikes. I'm paying for that. That also means that I need one of these option contracts to pay for the other option contract if I'm correct, right? I don't need, if I buy this put and the market goes down, if the market just goes down to this level, now this is at expiration, right? That's not enough to offset the loss on the call. And so I need an explosive option contract. I need my put delta to go to -1 as fast as possible. And the only way that it can do that is to get deep in the money. And if you start at the money, you have a higher probability of getting deep in the money. So your options react quicker in this scenario, right? Even on the other side, if you did the call side of things and it gets in, it's got to pay for that put. So we start with an at the money option. That means the delta is going to be close to 50, and it's an explosive option contract. And as you go up, it goes up very quickly to the upside, helping to offset that loss on the put. So that's why I never really talk about long strangles. And if we flip the script and we looked at a short strangle, which I can run down here, that's in the All-Stars. We don't talk about that one too much. Short strangle, and we flip the script. Now I would be looking more so to do the strangle as opposed to the straddle. Every reason why I just mentioned that I'd rather do long straddles is a reason why I would rather do a short strangle if I was going to do the opposite side of the market. And then if you take it one step further, here's a trade we do talk about a lot here on Options Guide TV is the iron condor. So you would just flip the script, buy the wings, buy a protective put or buy a protective call, strike D is a call, and buy a protective put, strike A. And then now you cut off that unlimited loss on the way downside or the way upside. Okay. So let's jump back out. Here we go. And I'm going to tab over to the TradeHawk software. All righty. And let's bring that up. IWM 197.38. Very simple. We're going to go out to March. We're going to spend a few dollars. Now, remember, we're not that worried about losing everything. If we're doing 16 days, but anywhere from 7 to 9 days is probably our out if the market does not move. If the market doesn't go anywhere, we're probably going to get her out around the 21st or 23rd, but we got some extra time just in case. And on top of it, it would have to stop right at that strike price in order for us to lose the maximum. So here's our paper trade for the week. And then we'll look at a Coinbase trade too. We're looking to buy, I apologize for bumping the table. We're looking to buy the March 1st, 197.50 strike call at the same time. Buy the March 1st expiration 197.50 strike put. Net debit of $7.40 to the account. We got a really good market in these, and I do like IWM because of that. So $7.40 is our max risk. That means $740 for every 1-by-1 straddle that we do, long straddle. And we're not going to let ourselves lose that entire amount. It's still probable it would have to stop right at 197.50. And just to finish the thought, let's send it to the what if calculator. And you see this. So right now, this is as of today. That is the green line. Here is at expiration. So you start right around the 0 line. and you can move it forward if you want, but let's go. Yeah, let's do it. What day did we say? The 21st or 22nd? Let's move it to there. Okay. So on the 21st, if the market stays right where it's at, we'd be down $200 on our trade. Oh, that means implied volatility. So this is in theory, right? I'll pull that down. But all I did was grab the calendar, went to the 21st. If I go to the 22nd and I look at where that bottom line is, that's down 207. And your eyes got to focus over on the P&L side on the x-axis. This is the y-axis, that's the x-axis. And you see that it says down 203.80. Oh, I guess I can keep it right there. There it is. All right. I didn't think my mouse would allow me to do that. But that's showing where it's at. So if we stay to that day and the market doesn't move, that's the type of risk I would expect, somewhere around that range. This is in theory. So I don't mind this trade. I don't mind this trade at all. You have a hard out after a few days. We need a solid move. And I do not mind legging out of the trade. If the market goes up, take off one side. You could even say, well, paying $7 for it, if I can get $7 for just a call or just a put, I would get out. I normally would stay and want to look for $8 or $9, maybe $10 on one side. But I have done a lot of long straddles where you sell the call side of things and then the market goes back down and you sell the put. And then you just need a few dollars on the put, right, to make that side profitable. It's just, I like those trades. So I want something that's got some volatility, not a ton of volatility, because I don't want to pay up for all that volatility, right? And I want something that isn't based off of news. I don't like long straddles around earnings. You're paying too much implied volatility. The news is known. Like right now, actually, and I've done this before in Boeing with a lot of success in Boeing, actually. Boeing can be obviously blindsided by headline news because they just had a door fly out of one of their airplanes. And because of that, and the potential to get blindsided by news in Boeing, that makes Boeing interesting to do long straddles. I wouldn't want to do it around earnings because the vol's already going to be in there. I want to do it when the news is unknown and a company could get blindsided by it. Here in the Russell 2000, we're doing it 100% because of the charts. All right. So I already see we got a few comments. JV's back again. Okay. Brian, what adaptation of the SPY put spread did you have in mind? Buying one more of the 494 puts, inverse put butterfly adaptation to be done. Okay. We put that up there. And let's throw this one up. That's the finishing question. Didn't really have anything in mind. And JB, here's the way I looked at it. And I've talked about this before in the S&P 500 index. If I were to do something, I might have done it yesterday. Today, I would probably just close the SPY trade and get out of that position. It really was, when we put the trade on, very short term, very speculative. There's really not an adaptation that I would do on a short put spread with only 1 day remaining. So we got this, and let's go back to it and see if I can come up with something on the cost, because we aren't 100% loser. We're at 496. I mean, this trade at this point in time has a decent chance of actually getting up to 498. The one thing that is true, which is way different than the SPX, and I should emphasize this, JV, is, to be done yesterday. What might have you done yesterday? Well, yesterday you can always roll it into just a butterfly. I don't think I would do the skip strike inverse put butterfly. I don't know. I don't think it has to be inverse. Okay. So here's where we're at. The trade actually could make it. We're 1% move up in the SPY would be feasible. And we're at a 0.5% move up $2.20. So it'd have to be up $4. We basically have to reverse the move that it did yesterday. And yeah, there's a chip in a chair. There's a possibility. Okay, I'm looking at it right now. Here's one thing that I may do. We sell that. It's going to cost us money though. Yeah, I don't really like this trade. If you rolled into a put butterfly, you sold this and let's go to 502 and you buy this, right? You sell that, you got one of those, and you buy the 502. What is that debit? $2.30. So in this instance, you're adding 4 points. You need it to stay below 498, and this would max out. So you got to think of it. A lot of times when I look at these adjustments, JV, I'm looking at getting them done for a net credit and not adding any additional risk. Here, well, you're adding additional risk, but getting it done for a net credit to the account, people feel more comfortable about that, right? We're not adding any additional margin by doing most of our adjustments. And in this case, we're not bringing in a net credit. You would get paid if it stayed around 498. And you're paying 230 for a 4-point wide put spread, hoping that it stays below 498. And in this instance, you're hoping it comes up to 498. If it does stay below it, you got to hang with me here. If it does stay below it, you're going to make basically what you would have lost, right? So, and this is literally off the cuff, okay, JV? This wasn't my plan at all. I really would have just closed it out yesterday. I would have probably been out of the trade when it came down. Once it broke through under 500 and hit 498, I probably would have closed it. That would have been the way to look at it. Just because it was such a short-term, just off-the-cuff trade. 502 minus 498 is $4. You're paying $2.30 for it. That's $170. And I would like it better if we were in the SPX, because you're now dealing with exercise and assignment. In the SPX, it's just cash. It's part of the reason why I like to just do the SPX. If you ride it all the way to expiration, all that happens is cash changes hands in your account because they're cash settled options. Now we're in the SPY, but do you get this? Does this make sense, JV? Just want to make sure to you that it makes sense. If you put this on, you're adding $2.30 worth of risk. You get hurt if the market continues all the way on up and blows beyond 502, because you're going to lose on your short put spread what you would make on this trade. Also, you're going to do fine, though, if the market goes down, because on 498, no, then you got the risk on your other side. But on 498, you would need to think that the market's going to stay here or drift higher towards the 498 level. And if it does come back up towards this level, you're going to get the benefit of making $4 on this side of the trade. I don't really like it that much, but it's fine. It's not a bad alternative to roll this into a long put spread. So then your position that you have on would be this. And let's add the 498 down to 494. We buy that. And let's send this to the what if. And then the market here's is 496.24. You would want it to go right here. If the market comes all the way down, this offsets a little bit of your loss because you have this long put spread on this side, and that would max out at $4, and you would lose whatever you would lose on this on the downside. So if you think it can stay somewhere within this range, it's not a bad alternative. All right. And I'll slide this down, give you one quick peek of that. And this would be your ultimate trade. You'd be short two of the 502s, 494 and 498. I don't like it that much, but it's okay. See what would have happened. Do it on paper. All right, here we go. Let's look at coin. Oh, we're long. Okay, but so the coin, I'm just going to do something real quick. I like the momentum. I like where the chart is at. Let's straddle the market. Let's take the implied volatility out of the market, and we'll do a 50-50 trade based off of earnings. I like that they're going to be announcing on the 15th, which is tomorrow, and I think it's after the close tomorrow. I'm pretty sure that it is. So in this instance, we're just, and this also means that you would maybe look to put this on tomorrow before the close of the market tomorrow. But the way that we would set it up is we're just going to straddle the market. And so you can go 5 points if you want to put on a little bit of risk, or we'll just go, you could go 10 points, or you can go 5 points because there's 2.5 point strikes. I'm going to do the less speculative one. I'm going to buy the 155 and I'm going to sell the 160, and this will make it a 50-50 bet. Basically, you're paying, you're 5 points wide. You're paying $235 for it. You're taking out the time value. You're buying $7.90 worth of time value, and you're selling $7.72 worth of time value. You're buying almost as much time value as you're selling. That usually hints that it's going to be a 50-50 bet. We're a little bit to the downside. We're at 156.98 at this point in time. So we're hoping we get a bump up. A little scary that it's been reacting to, I guess, Bitcoin setting a $1 trillion market cap. What has happened in Robinhood. There might be a couple other cryptos that have announced earnings around then. So that makes me a little nervous, but I still think there's some strength. I like, if anything, this promotes the breakout in coin. So this is where I'd want to go. Once again, you're flipping a coin in Coinbase. 50-50 bet. But actually a little less. You're risking $2.35, hoping to make $2.65. That's the maximum on the upside. You got 1 day for those options to trade. That's simple. Take out the implied volatility and just do that trade. All right, I'll take a picture of this. We'll leave it there. Sorry I went a little bit long, everybody. We will see you on Friday for the next edition of Options Guy TV. If you're on the Tradier YouTube platform, please click subscribe, ring the bell to make sure you get all the alerts. Share this with your friends and family and X.com, everywhere that you want to. Eventually, we're going to start streaming it to my X handle, which is very simple. It's at Brian Overby. Thanks for coming, everyone, and we'll talk to you soon.